Let's get talking to a guest now, joining us from the sidelines of the ongoing Kotak Equity Annual Global Investor Conference. Nischint Chawathe of Kotak Institutional Equities joins us now. Hi Nischint, thanks so much for joining us. I'm going to talk about the space that you watch closely, the non-banking financial institutions, and the way, we've seen the slowdown in terms of loan growth and retail lending in this sector. What is the view that you have in general about the NBFCs and how an investor should approach this space? I mean, it's been growing at a rapid trajectory for the past so many quarters, but now we've seen some signs of slowdown.
Yes, I think very clearly what we have seen is that some of the NBFCs have grown at a very rapid pace. I mean, I would put it as somewhere close to 30 to 40% over the last 2 to 3 years. And every year it's been like we always were wondering whether they can maintain the pace of growth for this particular financial year or not. But every year they have been surprising on an upside, and they have been able to maintain that kind of a pace of growth. I think finally we are getting a sense that we should see moderation from a very high base on some of these companies. So companies which are growing at 30-40% will possibly grow at a pace of 20% or so in the next financial year. Obviously 20% is not a bad ratio to not a bad rate to grow at, but then very clearly we are clearly seeing a moderation from the highs that we saw in the past. I guess what's happening is that auto sales are slowing down, and you cannot have a situation where auto sales slow down consistently and auto finance companies somehow just don't get affected by that. So somewhere it is now getting reflected in the numbers for auto finance companies as well.
So what's the pick of the pack? Nischint, on that same note of, let's not get into housing finance and power finance companies. If you only stuck to the auto vehicle financing set of companies, the Bajaj, the Mahindras, such like, what's your pick of the pack? Because while volumes will fall, they will be perhaps differentiated in terms of asset quality and margins.
See, I think that is true. I think the other point also what I would want to make is, if you look at, I mean, our pick is Shriram Transport, and the thought process here is very simple. FY12 was a bad year for them. On the back of a bad year, on the back of a very low base, they are able to report moderate growth this year. And here what we are saying is that you may not really see very high growth rates, but then clearly from a 12-13% growth rate last year, we are looking at a 20% growth this year, and possibly another 17 to 18% growth next year. So from all operating parameters, whether you're looking at asset quality performance, whether you're looking at growth, or whether you're looking at margins, we don't really expect a disappointment out here. The expectations, or general street expectations on the stock, are not all that high, given the fact that FY12 was a big shock for this company. So which is where what we are saying is that as compared to other companies which have really now started to show some signs of moderation, although they may also be growing at a 20% kind of a pace, because they are showing some kind of a moderation and they are already trading at higher valuation multiples, maybe Shriram could actually land up being an outperformer.
That's what many auto analysts have told us as well, Nischint, about the fact that because the commercial vehicle space has had such a bad year, it cannot follow it up with another bad year, something that we've never seen in the past, 2 bad years back to back. Is that really simplistic in terms of an assumption? What if there's another bad year that the commercial vehicle space or the auto industry may have? Then how does your argument hold?
See, I guess it's also to do with the definition of what is a bad year, whether you're talking about a negative growth or whether you're talking about a moderate growth. The way I would put it is that if you look at the business of Shriram, they are largely focused on used commercial vehicles. Used commercial segment typically tends to be a counter-cyclical segment. So when the new commercial vehicle business slows down, the used commercial vehicle segment picks up, and the reason seems to be very very logical, that the EMIs for a used vehicle are much lower than that of a new vehicle. So you might, if you are a commercial vehicle operator and the economy is going through difficult times, you may actually want to buy a used vehicle which has a lower EMI than buying a new vehicle which has a higher EMI. So this is something which is actually helping the company to clock higher growth. If you look at the breakup of growth that the company is delivering over the last 2 or 3 quarters, it is very clear that new vehicle business is slowing down, and possibly maybe third quarter was just where it was a little flattish. Second quarter was where there was a sharp decline. But the used vehicle business is something which is picking up very rapidly. Used business is something which is picking up clearly at a north of 20%, maybe because of this particular trend that is playing out, and that is exactly the reason why the company is able to report high growth rate in FY13.
Before we run out of
somewhere
time,
there is a counter-cyclical buffer also built in the entire business model, and I think that's something that one should take a note of.
Okay, I'm just dragging you to the other sectors before we lose time. In the housing finance space, I mean, LIC housing, of course, was a disastrous performance. But basically in the housing finance space as well in the power finance space, what are your picks?
Housing finance, I mean, frankly speaking, we are, we have a restricted view on LIC at this point of time. HDFC, we have certain concerns on valuation, so we don't really have a very strong pick out there. One trend that I may want to point out over here is that over the last 2 or 3 quarters, we are actually seeing a trend where somewhere we are able to see stress in this commercial developers portfolio. So we are able to see NPLs for LIC housing finance. There were some other issues regarding liquidity for some of the listed players. So I guess somewhere this trend is playing out, and one may want to really be very careful about it. As of now, obviously HDFC is just not affected, but clearly one may want to wait and watch and see how the trend plays out. Obviously HDFC is kind of writing a more superior business as compared to other housing finance players. But I mean, if there is stress in the portfolio, then you might just want to be a little bit more careful on that name.
What about PFC and REC? Yeah, go ahead.
So I think on the power finance space, PFC and REC were possibly the best, were the most surprising or most positively surprising results during the quarter. The biggest surprise came in from the margin expansion, and these companies have been consistently expanding margins. For REC, the margins are at all-time peak levels of 5%. Even for PFC, the margins are somewhere close to 3 to 4 year peak levels. So while we are saying that there are asset quality issues out here, there are challenges in the power sector, somewhere these stocks are kind of trying to, or somewhere these companies are trying to compensate themselves by earning higher margins, and then to that extent their return ratios would be higher. So they are also very indirectly trying to create a buffer for themselves. So yes, I mean, there are certain macro issues which obviously one doesn't have a solution. It will take some time for things to evolve. But while there are macro issues, these companies have done well from their side in terms of margins, on their margins, and trying to build buffers for any likely stress, and which is the reason where in the immediate term you could have some kind of a rally in specifically PFC.
Okay, very quickly, I'm being warned we are running out of time, but the RBI Deputy Governor has said that the final rules will be out by March 31st, by the end of the financial year. AB Money, L&T Finance, any of those companies you would go long on?
I think L&T Finance, from a pure valuation point of view, it seems that most of it is kind of already priced in. There is a big disconnect between the current market price and our fair value estimate for the stock. So I will not be able to put a trade out there, but yes, clearly these would be some of the stocks that one may want to watch out, especially for the banking license.
All right, thanks so much for joining us. We've been watching out for this one for the longest time. I hope by the next month there's some clarity on the final banking license guidelines. Then perhaps we'll see.